Hello, fellow compounders. Welcome back. Can you turn $1,000 into $100,000 by investing? Warren Buffett turned an investment of $7.50 in 1962 into $496,000 today. That's the price of one share of Berkshire Hathaway. In this video, we'll be talking about successful stock investment tips given to us by the Oracle of Omaha himself, Warren Buffett. We'll break down his tips for both passive and active investors, complete with real-world examples. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you are responsible for your own financial decisions. For those of you who are new to the investing world, Warren Buffett is the chairman and CEO of Berkshire Hathaway, one of the most successful investment conglomerates in the world. Over the past 8 decades, Buffett personally amassed a fortune worth over $100 billion, all through his smart investing strategies. So, it's no surprise that many investors look up to him for guidance. Passive investing is an investment strategy that aims to maximize returns over the long term by minimizing the amount of buying and selling, and therefore minimizing fees and taxes. This approach is perfect for those who don't have the time or inclination to actively manage their portfolio. Let's look at Warren Buffett's advice for passive investors, along with some examples. Tip number 1, invest in low-cost index funds. Buffett has always been a strong advocate for index funds, especially the low-cost ones like the S&P 500 index fund. He believes that these funds offer a simple and cost-effective way to diversify your investments and get exposure to the overall market. A great example of a low-cost index fund is the Vanguard S&P 500 ETF, ticker VOO. In fact, Buffett famously instructed the trustee of his estate to put 90% of his wife's inheritance in a low-cost S&P 500 index fund and the remaining 10% in short-term government bonds. Tip number 2, focus on the long term. Warren Buffett advises passive investors to focus on the long term, as this helps to minimize the impact of short-term market fluctuations. He believes that time in the market is more important than timing the market. For example, if you had invested $10,000 in the S&P 500 index fund 30 years ago and let it grow, you would now have over $160,000, assuming the average annual return of 9.6%. So don't get caught up in short-term noise. Instead, stay invested and let the power of compounding work its magic. For those of you who prefer a more hands-on approach to investing, we'll now cover Warren Buffett's advice for active investors, along with real-world examples. These tips are based on the 4 filters he and his partner, Charlie Munger, used to pick stocks for Berkshire Hathaway. Tip number 1, understand the business. The first filter is understanding the business. Buffett believes that you should only invest in businesses you can truly comprehend or understand. This means that you should be able to explain how the business makes money and what factors could impact its future performance. A classic example is Coca-Cola, a company with a simple business model that Buffett has invested in for decades. By sticking to businesses within your circle of competence, you'll be more likely to make informed decisions. Tip number 2, ensure a competitive advantage. The second filter is ensuring that the company has a competitive advantage, also known as a moat. A moat is something that sets the business apart from its competitors, like a strong brand, cost advantages, or a vast distribution network. A great example of a company with a strong moat is Apple, which has built a loyal customer base, a robust ecosystem, and a powerful brand that allows it to command premium pricing. A strong moat makes it difficult for competitors to take away market share, which ultimately leads to better returns for the company and its shareholders. Tip number 3, assess the quality of management. The third filter is assessing the quality of the company's management. Buffett believes that a great business is only as good as the people who runs it. He wants to buy companies that are run by honest and competent people. A prime example of exceptional management is Microsoft, with leaders like Bill Gates and now Satya Nadella, who have all contributed to the company's long-term success. Look for management teams with integrity and competence, and a track record of delivering results. Moreover, a management team that treats shareholders as partners and is transparent in their communication is a great sign of a well-run company. Tip number 4, buy at a reasonable price. The fourth and final filter is to buy at a reasonable price. No matter how great the business is, you don't want to overpay for its stock. Buffett suggests looking for companies that trade at a discount to their intrinsic value. Intrinsic value is an estimate of what the company is truly worth. For instance, Berkshire Hathaway's purchase of BNSF Railway in 2009 was a prime example of buying a strong business at a reasonable price. BNFS has since provided substantial returns to Berkshire. By purchasing stocks below their intrinsic value, you create a margin of safety that can protect your investments in case of market downturns or unforeseen events. So there you have it, folks. Warren Buffett's top investing tips for both passive and active investors, complete with real-world examples. By following these tips, you'll be well on your way to building a successful investment portfolio. Remember though, that investing always comes with risk, and it's important to do your own research and consult a financial advisor if you need to. Thanks for watching. Remember to always be compounding. See you in the next video.